The opinions expressed on this program represent the viewpoints of individual authors or contributors and do not necessarily reflect those of Troy University. This is EconVersations, a joint production of Troy Trojan Vision and the Manuel Johnson Center for Political Economy. Now, here's your host, Dr. Dan Sutter.
Hello and welcome to EconVersations. I'm your host, Dr. Dan Sutter of the Johnson Center for Political Economy at Troy University. Banks occasionally fail in the United States, but the failure of Silicon Valley Bank in March 2023 created a wave of concern in financial markets. What went wrong at SVB, and did the bank receive a bailout? What are the costs when banks or depositors get bailed out? And why do investors in financial markets get so rattled when banks are in trouble? Joining me on EconVersations today to discuss this is Mr. Peter Earle of the American Institute for Economic Research. Peter holds a bachelor's in engineering from West Point and master's degrees in economics and finance. And he worked on Wall Street as a trader and an analyst for over 20 years. He now researches and writes about financial markets for AIER. Welcome back to the show, Pete.
Great to be back.
Well, so let's get started here. Before we get into anything more, tell us a little bit, how is it that a bank actually fails in this case? Because, as depositors, we think of it like as a place we have our money in, but a bank also is a business with some capital being contributed to. So tell us a little bit what it means for a bank to fail, as SVB did.
Sure. So the failure of a bank can occur for several reasons. The main manifestation of bank failure is when the market value of its assets fall below the market value of its liabilities. What that means is that the bank's ability to cover the withdrawal of deposits is impaired.
Okay. And then that's what happened to the Silicon Valley Bank. But before we get into some of the details of that, the SVB was described as a regional bank. And some people pointed that like regional banks weren't subject to the same level of scrutiny in the aftermath of Dodd-Frank as some of the largest banks. What is meant by a regional bank, and what's the difference between that and some of the largest national banks?
So a regional bank is essentially a bank that specializes in local lending. The theory goes back to a less technologically advanced era when lending was more of a personal business, and the banker would know the local area, they'd know the people, they would probably know what sort of businesses were likely to succeed and which weren't. But today there's a regulatory definition. The Federal Reserve, which is a bank regulator, in addition to the agency which plans and executes monetary policy, defines a regional bank as one with between 10 and $100 billion in assets.
All right, so they're sort of like the medium-sized banks, although SVB got up to be, I think, the 16th largest bank in the country when it failed. So, now, one thing that happens, and one reason markets get jittery when banks are in trouble is we can have something called a bank run. And you hinted at this because we were saying that if a bank loses some of the market value of its assets, it may not be able to meet all of the depositors' demands if they should want to withdraw their money. So tell us a little bit what goes on with a bank run, and then how sometimes even like a sound bank could fail due to a bank run.
Right. So a run on a bank is when depositors suspect or actually find out that a bank at which they have deposits is either unable or likely to be unable to make them whole. In other words, if I have $100 at a bank and someone tells me, or I figured out that the bank's assets may be dwindling or even gone, I'm going to go to the bank in a hurry and probably try to withdraw my $100. The problem here is that owing to fractional reserve banking, banks are rarely liquid enough to cover the full amount of their liabilities instantaneously. So they couldn't technically pay out all their deposits immediately if there was, a rush to demand those balances. So, they may have 50 billion in assets, 40 billion in liabilities, but say only 10 or 20 billion in liquid in cash. So that's why rumors can be really devastating for banks, because a rumor that a bank's in trouble can start a run, which quickly becomes a self-fulfilling prophecy. And if any of the viewers of this show are planning on going to grad school, I'd recommend look up the Diamond-Dybvig model, which sort of illustrates the way liquid assets or illiquid assets and liquid liabilities can play out when it comes to banks.
Yeah, and during the Great Depression, I mean, as bank runs were causing were the primary cause of almost a quarter of the nation's banks failing, and
Right.
like a complete collapse of our financial institutions then. But we did during the Great Depression in 1933, we introduced deposit insurance to help counter this. And so you might think that now that we have deposit insurance, we shouldn't face this. But tell us a little bit how the deposit insurance works, because we'll have to come back to this later on, because this is all part of this story. But tell us first off what's involved with deposit insurance and how it normally works.
Right. So deposit insurance is essentially a government program, although there are private programs, but usually we're talking about the FDIC, that's the Federal Deposit Insurance Corporation. And they promise that if you have a certain balance in a bank account up to a certain level, you'll be made whole for that amount, often very quickly, if a bank fails. Now, if you have as little as a penny, this is theoretically now, of course, if you have as little as a penny more than the balance, which is in which your account balance is not covered, you could lose it.
Mm-hmm.
So the current FDC insurance coverage limit is $250,000 per depositor per bank per ownership category. So if you had technically, say, $250,001 in such an account, you may lose $1. In the case of SVB, though, it's much more than that. But I don't think we want to get ahead of ourselves at this point. That's how deposit insurance works.
Yeah. Okay. So now let's try to start to get into the problems that we had, that SVB ran into. It was related to interest rates. And of course, the Federal Reserve was raising interest rates starting back in 2022 to help control inflation. But that ended up causing problems for Silicon Valley Bank. So tell us a little bit how that panned out.
So the failure of Silicon Valley Bank had to do with what's called the duration gap. And that's basically an asset liability mismatch caused by interest rates. Mm-hmm. In banking, short-term liabilities, that's deposit accounts and CDs and that sort of thing, fund long-term assets. So deposits are used to make loans, to purchase securities, and that sort of thing. The problem is that short-term liabilities have variable rates, and deposits are on demand, so they can leave the bank at any moment. Mm-hmm. And those are funding these assets tend to be things like treasury bonds, long-term agency securities, all that sort of thing. So those long-term assets tend to pay a fixed rate. So you've got sort of liquid short-term assets with variable rates funding long-term assets, which are pretty illiquid and pay fixed rates. That's essentially what happened. And while this event, and we can get more into it, is what killed Silicon Valley Bank, I would note that right now, months later, U.S. banks are still sitting on something like $650 billion worth of unrealized losses because of these mismatches. So, it was fatal for a few banks, but there are many that are still having trouble because of it.
And so, I mean, the problem being is that if you've got, like, especially loans that are out at a fixed interest rate, and then that the rate that you have to pay on deposits, because if you're not paying it as one bank, somebody can take their money and put it somewhere else to try to get that better rate. At the very least, it's going to squeeze your profits. But in Silicon Valley's case, it actually led to them having some losses from treasury bonds. So tell us a little bit about how is it that if you're holding treasury bonds at one interest rate in an environment of rising interest rates, you could end up suffering losses on those treasury bonds?
Sure. So the Fed controls really the first year or so of the yield curve, right? So as the Fed began raising rates, they began raising rates very aggressively. And when these rates were rising, they ranged from, say, 1/4 or 1/2% by 75 basis point moves. You're already talking about the target rate of interest rates being suddenly in a few months between, I guess it was 2.25% and 2.5%. Now, originally, Silicon Valley Bank was paying out, let's say, 1/2 to 3/4%, and what it was receiving on its long end from the agency and long-term treasury bonds was, let's say, I'm going to guess 2.25%, which is a good business. If you're borrowing at 1/4 or 1/2%, and then you're being paid at another rate That sounds, that's a good business. What happened was in a short amount of time, the short end, where they had to pay out to depositors in order to keep them, invested in their accounts and not looking for other forms of return, was higher than the agency and treasury rates that they're receiving on the long end. So suddenly you're losing money, and you have, not only are you losing money in terms of taking in less than you're paying out, but also you have a loss of deposits that are going into now more competitive investments like some certain bonds, maybe into CDs, maybe into other banks' deposit accounts. So it's a problem. That's how everything started.
And so then if you had a treasury bond that maybe had a multi-year duration, but it was going to pay like
Right.
2 or 3%, and interest rates start to rise, all of a sudden, like nobody really sort of wants to hold a bond that's paying 2% when interest rates have gone up to 5 or 6 or 7%, because that's not a very attractive bond anymore, right?
Right, and the other thing is that end of the yield curve, those really long dated agency and U.S. Treasury securities, is extremely illiquid. It's one thing to buy those bonds; it's another thing to sell them. Usually, you only get maybe some Treasury dealers buying selectively, or insurance companies out there. So it's very illiquid. So if you were to say, as Silicon Valley Bank did at some point, try to sell a couple of $1 billion worth of long-term treasuries, you're going to have a lot of market impact. You're going to have to basically sell lower in the market than you would want to in order to get somebody to buy your holdings. But I don't want to get ahead of ourselves. But basically, that's what happened: is the bank determined that its liabilities, the deposits, were leaving at a rate which eventually might have impaired its ability to pay. So what it decided to do was try to liquidate some of its treasury holdings, and in so doing, it took some pretty heavy losses.
Now, you've explained to me before, so let's just see if we can get into this, that other banks didn't all fail from this problem, and there is something technically, it's a bit of a technical thing, because I wasn't completely familiar with it until you were explaining it to me.
Right.
But there is something called an interest rate swap that could be used to help protect your position on these treasury bonds. So you've got a bond, and the interest rates are going up, and that bond's not going to be very attractive, and you're looking at either taking a loss on it, or you could do something else prior to have hedged your position, I guess is one way to describe it. So tell us about this.
Sure. So I should also mention here that a lot of these bonds that were purchased, these treasury bonds and some of these agency securities, were purchased when interest rates were very low. So the price and the price of a bond and the interest rate move inversely. So when interest rates were very low, the prices of these bonds were near record highs. So essentially, a lot of these banks top ticked the market. They paid the highest of the high prices that they could have over, say, a 20-year period for these bonds. And the minute that interest rates started to rise, the price began to fall, and they began to lose on the principal basis, on the face. But there's a few ways that banks can hedge against adverse interest rate moves. One way is to just try to diversify as much as possible, to try to buy bonds of varying maturities, such that they have exposure in the 1 to 5 year, 5 to 7 year, 9 to 11, and then so on. So they're pretty much equally rated based upon what they think. There's an element of forecasting and speculation here, based upon what they think the future of monetary policy and interest rates is. But that's difficult for a regional bank. Although what banks and other firms can do is they can swap out their interest rate exposure using an interest rate swap, which means for a fee, a firm like Silicon Valley Bank would go to an investment bank and some sort of financial institution, and they would basically pay to receive a variable rate and swap out their fixed rates. So somewhere out there's a firm that has variable rates that would like to have fixed rates. And so what an investment bank would do is find the other side of that trade and basically say, okay, Silicon Valley Bank, we've set this up so as you received fixed payments, those are going to go somewhere else. And as this bank or this other financial institution you may not even know receives variable payments, those will get paid to you. And what that means is that you're going to have a flow of income. Your interest is going to float with interest rates instead of being stuck at a level where you're constantly falling short of where inflation actually is.
So rising interest rates would cause a problem. But again, as often there is in financial markets, there's some way to sort of protect your position and not take as big a loss as you would have otherwise. I mean, you'd have to pay some money to get one of those swaps, but
right,
you wouldn't lose as much as you would if you were in an unprotected position.
Yeah, at the time, so the thing is, with a lot of these hedges and things, you want to have them on before you're in trouble.
Yeah.
If you go to an investment bank and to another large financial institution, you try to put these on when there's a lot of volatility and when there's a lot of stress in the market, you're going to pay a higher amount. Now, of course, I would rather pay a higher amount than become insolvent. But it would have been costly to put on an interest rate swap in March or April of 2022, but it probably would have saved the bank. Who can say? There's another thing that a bank can do, and that's called immunizing the book. And all that means is entering into a series of trades which shift the weighted average maturity of the bond holdings. So if SVB, which was really heavy in long-term bonds, had undertaken a series of trades, which also might have been costly, they could have swapped out, I shouldn't use the word swap in this context, they could have traded away some of their, say, 20 to 30-year exposure in exchange for, say, 10 to 20-year, 10 to 15-year exposure, and that would have reduced their exposure. Even that's questionable, though, because, again, markets have become very liquid and there's a lot of volatility. But still, these are things that they could have done. And hopefully, or not even hopefully, but I expect some banks actually did this at the time. And that's why we had a limited number of true, failures and banks in distress at that time.
Yeah. And you were mentioning that, although these are things I wasn't familiar with, if you're in the industry, if you're in finance, you know what these things are. And at some level, it was sort of like malfeasance on the part of the people running Silicon Valley Bank that they didn't take some of these steps.
Yeah, I mean, there's a lot I could say about that.
Malfeasance might be a little strong, but it wasn't like this. This is something nobody else would know about.
Yeah, so I mean, there's a few issues. We can talk about distractions from the business of running a bank later if you'd like.
Yeah.
Another thing is that without becoming too condemning, I would say that a lot of people rise to the top in financial institutions, maybe not by being the best at what they do, but by sort of outsitting their opponents. So I don't know if this is the case with Silicon Valley Bank, but I certainly saw in the financial markets in my time there that a lot of times the people who were running banks or running trading desks were not necessarily the best traders, but maybe they were the most politically adept, or maybe they were just the ones who had avoided controversy, even when there was a good, even when there's something to be controversial about, or raised an unpopular opinion to. So there's a lot of reasons why they might not have had these swaps on. And actually, another thing, Dan, if you don't mind, we have to remember that we haven't had inflation like this since you and I were kids.
Yeah.
So this is a lot of knowledge in finance and economics is cyclical and it's not cumulative. So many of these people, even if they entered the business in, say, 1985, they were never around this type of inflation and this type of interest rate volatility. So one could understand how this might not have been right, at the front of their book of strategy as things began to get messy in the spring of 2022.
So we mentioned deposit insurance, and so Silicon Valley Bank was taking some losses. Now, normally that wouldn't necessarily cause all the depositors to run and get their money out of the bank, because if you've got deposit insurance and you're going to be protected on that, they wouldn't have to. But that wasn't the case with most of the Silicon Valley Bank customers. I mean, they were, you mentioned this $250,000 limit for deposit insurance. Many of them were well over that, right?
Yeah, I think the average account balance was something like $5 million. And what that means is that for the entire bank, about 95% of the actual deposits were statutorily uncovered.
Yeah.
Those balances should have been lost, but they weren't. The FDIC decided to step in and not only make their funds available, because sometimes these bank resolutions take months and years to do, but also to make the full amount of their deposits available to them. So it was a good time to be a Silicon Valley Bank share a depositor at that time.
Right. Yeah, because now we want to get into this question: was this a bailout? And I mean, certainly, you have to be careful here, because yes, there was a change made that helped some people out, but there's the depositors and not the owners of the bank. And you were mentioning before, the owners of the bank have been wiped out.
Yeah, so the price per share of Silicon Valley Bank was something like $250 at the start of 2023. By February, it reached $333. And this morning, in anticipation of this interview, I took a look, and currently Silicon Valley Silicon Valley Bank stock is trading at 9 cents per share. And it's actually, I mean, that's just a stub because the firm was actually taken over, or I should say taken under, by JP Morgan. So yeah, equity shareholders were essentially wiped out. So there's no moral hazard in that respect. Now we could argue that perhaps there's an element of moral hazard felt or experienced by the depositors who were not taught a pretty harsh lesson about the limits of federal deposit insurance.
Right.
But yeah, I mean that's a different issue. Any moral hazard to shareholders is absolutely marginal, if any at all.
And in 2008, the bailouts came in and helped a lot of the owners of at-risk financial institutions. So this was a very different thing. How you want to use the term bailout, I guess you can always debate that. But this wasn't a bailout of the owners of the bank. They lost, and I think they had about 20 billion, billion with a B, in capital invested in Silicon Valley Bank. And like you said, that basically was completely, they lost all of that money.
It's 99.9% wiped out. Yeah.
And so then you mentioned the term moral hazard. So if you can explain to us what moral hazard means with regard to our banking system, and then we'll talk about whether this worsened moral hazard.
Sure. So the basic definition of moral hazard is it's a set of circumstances where individuals have the opportunity to take an action and they choose to do so because the consequences are likely to fall upon another party. So for example, if the decision makers at a financial institution know that they are working at a systemically important and thus likely to be rescued institution, if they suffer severe losses and become insolvent, there's a game theoretic that comes into play of heads I win, tails you lose. There's no reason not to swing for the fences and incur what would otherwise be catastrophic losses if someone else is going to foot the bill or cover those losses. So that's essentially how moral hazard manifests.
And certainly, in the aftermath of the bailouts of 2008, people have, and the fact that many banks were declared to be too big to fail, that has led to a lot of moral hazard going forward. And that'd be really problematic because, as you said, now they actually know for sure they could take very risky investments. And one of the things is, okay, if it pays off, you get the money. And if the risky investment doesn't pay out, you have losses, you would be bankrupt, but you're going to get bailed out by the government. That's really not a game that we want our banks to be playing, because we'll lose as taxpayers, and it's also bad for our economy.
Yeah, I mean, there's that, and also it's just this idea that it quashes the sort of the incentive to innovate. For who wants to start a bank or a large financial firm? When it's known that there are a number that sort of have the Fed or the or the Department of the Treasury on speed dial, right? I mean, so there's less incentive for that. There's also it's bad for the economy in terms of systemic risk. There's a laundry list of problems that come from moral hazard, and you tend to get better outcomes for the country and for the economy if there's more skin in the game. That's something that's been written about a lot, is making sure the decision makers are on the hook for their own decisions.
And so then let's get into, at the time, a few months ago when this was happening, there was a number of concerns, a number of commentators raising concerns that this would would just worse, this bailout of the depositors would make the moral hazard problem worse. But I guess my feeling on that at the time, and it's not changed, is that this is not a huge change in terms of the moral hazard. We had $20 billion. We had the owners of that bank lose $20 billion. I assume they didn't want to lose that money. I assume that they were motivated to monitor exactly what the people running the bank were doing with their money, and not and not go out there and lose their money for them. So the only effect where you could say, well, perhaps these large depositors could have been riding herd on the people running the bank, but you really would have to try to say that you needed both the large depositors and the owners of the bank to try to control the people making decisions for the bank. And I know it might work out that way, but it seems to me that's rather a kind of a very marginal increase in moral hazard.
Yeah, I generally agree with that. Yeah, I think if there was a concern, it's that the deposits of that bank were really heavily dominated. It was a very narrow depositor base, which means it was very limited in terms of its diversification. You had mostly tech firms and also some of the northern Marin County, California winemakers and that sort of thing. So I think the concern was if a huge number, thousands of small tech firms were suddenly unable to reach their cash, were unable to access their bank accounts. That could send the economy of California into a tailspin and then the U.S. So it's not systemic risk in the same sense that, say, Lehman Brothers or AIG financial products might have been, but it's systemic risk in another way. Still, the bank wasn't rescued, but the the depositors rather, were saved from the error of their ways. So, well, I guess we'll have to see over time if there are any, long-term implications of that.
Yeah, and it does seem like Silicon Valley Bank had this very unusual. They were very big into venture capital, and like you said, they had these tech firms that were, and again, simply for if those firms' money had been tied up for a year or so, even they might have eventually gotten all or most of their money back. But just having it tied up for a year could mean that they can't make payroll, they can't do the other things they need to do to run their businesses.
Yep. I mean, at that time, there was a lot of uncertainty, right? Nobody knew exactly how far and wide, these bank issues might go, whether, what the state of the economy was going to be several weeks later. So I understand what the incentives were for the government to make those decisions. I may not agree with them, but I understand, they were facing a lot of uncertainty themselves.
Yeah. Well, the Silicon Valley Bank was very prominent. It was a very prominent spokesperson for what's called ESG investing, and for a bank, they were quite vocal about what they were doing in ESG. Tell us very briefly, what is ESG, and could that have had any impact on this failure?
Yeah, so ESG is essentially a framework for running institutions like firms and all that. It stands for environmental, social, and governance, and it espouses a whole series of ways that some people think businesses should be run in terms of their consciousness of the environment and all that. And I was actually snooping around the SVB website earlier this year, and they had page after page of ESG information on the bank, which I thought was kind of strange because it's a bank. Banks aren't really known for their carbon footprint. There's not a coal plant or something like that. So I would argue that time and human resources, or human capital being resources, even if a small portion of the effort that went into those extensive ESG reporting and observance efforts were directed at mitigation that duration gap and the interest rate problems. The firm might have been around today. I think even a single interest rate swap might have helped. A lot of them mitigate a lot of the issues that eventually felled them, and it probably wouldn't have taken much away from their ESG intensive efforts.
Well, and that's, like you said, not only is time and effort limited, and the time you spend on one thing you can't spend on something else. You also have the question of, if you have people who think that the main point of running a bank is to make society better through ESG investing, they might not think that like the details of covering your interest rate position is very important. Well, thanks very much.
It's probably more fun to write about. Oh, sorry. It's probably more fun to write about carbon footprints than to write about interest rate swaps.
Could be. Well, thanks so much, Pete, for coming on and talk about this with us, and thank you all for joining us. Join us again next time for another EconVersations.
This has been EconVersations, a joint production of Troy Trojan Vision and the Manuel Johnson Center for Political Economy at Troy University.